Bob Pisani was just outlining what he, I think, was saying sort of elliptically, is a rotation in the market away from big tech or tech and towards some of the more unloved sectors. Do you see that as well? And do you think that's a trend, an indicator of what's coming into 2021?
I do see that, and I'm on record as having talked about this for many months now, that 2021 is likely to look a lot like 2010 to 2012 looked, where we saw cyclicals, value grow faster off of a bottom than tech was. And sure enough, consensus next year expects for tech, outside of a few discrete components, to grow around 15%, while it expects the broader S&P minus tech to grow at 35%. So it's hard to maintain a premium multiple when other sectors are just growing, quite frankly, much faster than tech or typical growth is. So yes, I think now is a great time to go value shopping, to look for things that are on sale, that have triple-digit earnings growth projected for next year, and in many cases also have a healthy dividend to offer as well.
We're talking banks, we're talking energy, we're talking some of those unloved ones. But Larry, you say tech is no wreck and is a good place to put some money, even at today's valuations. And you're not persuaded that the value play is ready to roll.
No, I still prefer the stay-at-home names as opposed to the reopening trade because, you know, first of all, this economy is going to struggle over the next couple of months. And I think that's going to be more hurtful to those more economically sensitive sectors. I think fiscal stimulus is going to happen at the beginning of next year. And I think what's important is that if you look at the history of what happened when we got our first stimulus, what was the money spent on? Consumers spent on technology and healthcare. And then I'm not necessarily in agreement when it comes to valuations. When you look at some of the valuations of those reopening trades, you know, airlines and hotels don't even have earnings projected for next year. If you look at energy, it's trading in its 90th percentile. Restaurants in the 80th percentile. You look at some of the other areas like communication services, it's only in its 16th percentile. So you get much better valuation still because those earnings have kept pace with some of the price action that you've seen.
Shepard Smith here. Thanks for watching CNBC on YouTube.